Hi there, Adventist retiree. Steve Thurman here with Forward Financial. I have my friend and colleague, Mr. Leon King with Modern Financial Group, in a video call with me today. We're hoping to give you folks a bit of information and address some of the questions that I've been getting as of recent regarding the market, the volatility of the market, your Empower accounts, long-term care, properly structured annuities, how these different questions and vehicles may impact you and benefit you as we proceed into 2025. Just looking at the market this morning, looks like we're down about 12%. The S&P 500 is down about 12% since the beginning of the year. The bulk of that drop just in the last week, almost 8% just in the last week. We're seeing a little bounce up here. We don't know if it's a dead cat bounce or not. Time will tell, it always does. But more of you that have your retirement accounts through Empower are probably seeing a bit of a pain as of recent in your 403b accounts. So we want to address that specifically. I'm going to let Leon talk for a bit here, let him tell a little bit about himself, Modern Financial Group, and what they do, and we'll go from there. Go ahead, Leon.
All right, Steve, thank you. I appreciate you having me on here. And a little background on myself. I'm Leon King, based in Greenville, South Carolina. I am a U.S. Navy submarine veteran, also served in combat with the Global War on Terrorism, Operation Iraqi Freedom, Operation Enduring Freedom. And now I am the founder and CEO of Modern Financial Group, which is a full-service, comprehensive, holistic financial planning firm where we handle everything that relates to finances. So helping people to, to get their cash flow management under control, helping them eliminate debt, helping them to get their retirement planning done, making sure that they've got enough income to last them the rest of their life, and estate planning, wills, trusts, power of attorneys, tax planning, tax advisory, and tax strategy, college planning, money management, everything in between. If it relates to finances, we help you out with it. And our mission is to help you keep more of the money that you make and maximize the efficiency of money. So one of the unique things that we do is we help people find and recover money that they are unknowingly and unnecessarily losing to inefficiencies in their financial plan.
Wonderful. Thank you for the thorough introduction there. Let's jump right in here. So as of late, I've been getting calls from my client base specifically about long-term care. This is usually a pain point with a lot of my clients who may be getting up in years, 75, 80s, and are concerned about long-term care scenarios and how financially impactful they can be. Can you touch a little bit on long-term care, the options there, why it's important to at least have this discussion with each other, your spouses and your children?
Absolutely. Long-term care is one of those things that can completely devastate a financial plan if you don't have a good plan in place to take care of it. People are living longer than they have in the past, and with that comes some, challenges with medical expenses, memory care, whether it's Alzheimer's or dementia related. Just having somebody there to help with activities of daily living, whether that's in the home, whether that's in an assisted living facility, or whether that's in a nursing home, depending on the level of care. Most people would rather stay at home in their own house where they're comfortable if they can, and so we try to make that as feasible as possible by, if a family member is the one that's going to provide care, making sure that you can compensate that family member and take care of them, because a lot of times they have to step away from their career and give up their own retirement savings and goals and things like that to help take care of a family member. So we want to help you be able to take care of them or cover the expenses of having professional care, whether that's in your home or in a facility. The activities of daily living, being able to bathe yourself, dress yourself, eat and prepare meals, taking medications, being able to get up and out of a chair or a bed, all those kind of things like that are, those are essential to daily life. And sometimes as we get older, it becomes more challenging to do those things. And so we need some assistance. But But again, that's one of those things that paying for that care, the average cost of care. I remember when I helped out my aunt with this um, back in 2017. This cost was about 3,500 for just a basic assisted living facility at that point. Quickly, that went to over 4,000 because of help with medications and some other things. And then next thing we knew, having around the clock care and some memory care was in upwards of $10,000 a month. And that can drain a retirement account, a savings account, an inheritance that you're planning to leave to your beneficiaries. It can drain that really quick. So it's good to have a plan in place that helps to reduce and eliminate, if possible, that financial risk.
Fantastic, fantastic. Some of my clients are younger in age. These are people that are recently leaving the workforce, moving from that accumulation phase to the distribution phase of life, retiring, aging into Medicare. These are clients of mine that are in their mid 60s, 65, aging into Medicare up into about their early 70s. Most of my Adventist retiree clients that we're sending this video out today um, have a 403B through Empower. I know you've helped a handful of my clients in this very situation. Can you speak a little bit about the 403B with Empower, its performance, and maybe presenting an alternative that's superior to what these retirees are being offered ongoing as they move into retirement?
Absolutely. So yes, I appreciate you giving me the opportunity to assist many of your clients, helping to what I call rescue them from their underperforming retirement plans, right? Whether it's 403Bs, 401Ks, and all of that. But these 403Bs with Empower, when we look back at the performance of these plans, not only are there some fees and things that are associated with them that are kind of eating away at the savings there, but just the asset itself is just underperforming. We've seen about a 2% average growth rate over time in that, and that's not even enough really to keep up with inflation. Even at standard inflation at 2.5 to 3%, if your portfolio is only growing by 2%, you're losing ground. You're not even keeping up with inflation at that point. So we definitely have an opportunity to review those plans, see what the true performance of it has been, and then potentially explore some alternatives that can help to either reduce or eliminate those fees out of it. So again, you can keep more of the money that you make, but then also help you get the performance that you need out of that portfolio to surpass inflation, and then also be able to generate an income for life that's guaranteed that you won't be able to outlive. So you can guarantee that you'll never end up poor.
Can you elaborate a little bit more on that? It sounds like you're describing an annuity, and I know that word can be a bit of a loaded word with some negative connotation. I know this space, as far as annuities are concerned, has changed quite a bit through the decades. And can you touch a little bit on why annuities may have had a negative connotation and why that is no longer the case? And expound a little bit about this product and how it can be a superior solution to what these Empower retirees are holding now.
So yes, annuities has been one of those things where sometimes when you hear the word annuities, people cringe and they're like, "No, nothing. I don't want anything to do with annuity. I don't want to hear about that." And that is unfortunate, but I do understand why that is, right? Because in the past, annuities did get a bad rap because people had to give up a chunk of money and with the hope that they would annuitize that in the future, and maybe they passed away before they even got to the point of annuitizing that. Um, and then the rest of that money was just gone because it was just turned over to the insurance company, right? The insurance company kept it when the person passed away. There wasn't a death benefit associated with it or something. Or maybe, the annuity itself was, not designed for growth and was underperforming. And so it didn't provide the benefits that the person thought that they were going to get with it. But the truth is, annuities have changed a lot in the last few decades. And now annuities are a fantastic tool in the financial arsenal to be able to not only protect money, but also be able to grow that money and then turn that money into a lifetime income stream. Now there are death benefits that are associated with the annuity, and many annuities have an enhanced death benefit where you maybe put a chunk of money in there. Let's say you put $100,000 into the annuity, and immediately there's an enhanced death benefit that might pay out 120,000 to a beneficiary. So even for somebody who is unable to get life insurance for themselves due to medical challenges or something like that, they might be able to make their money go a little bit further. Again, maximize the efficiency of their money by strategically placing it into the right annuity, and provide that death benefit to the family. But also, again, get that growth. There's many indexing strategies that are out there. There's different types of annuities, and we can go into other explanations. When we meet one-on-one to find the right one, because there's over 720 different annuity products out there on the market. But we help you weed through all of that and figure out the one that is right for your situation. There's variable annuities, there's fixed annuities, there's fixed indexed annuities, all these things. But also, some people have thought that annuities were, heavy with fees and things like that. But realistically, that's not the case. Most annuities have little or no fees at all associated with them. In fact, most of the ones that I work with have no fees associated with them whatsoever. So again, your money stays your money. You're keeping more of your money. It's not going out to a money manager or to an advisor. It's not going to an insurance company, but you have the ability to protect your money, turn that into a lifetime income stream. And one of the biggest things with traditional retirement planning is something called the 4% rule. Some of you might be familiar with it. Some of you, this might be the first time you've ever heard about that before. But the 4% rule is what's considered the safe withdrawal rate from your risk-based retirement accounts. And so, if you've got $1 million portfolio, 4% of that is $40,000 a year, right? If you've done really well and you've made some good money throughout your life, $40,000 a year may not sound that exciting for you in retirement. And I would agree with you, right? Well, what if you're on the other end of the spectrum and you've got what the average American has saved, which is about $180,000 in your retirement account, right? You're looking at like $8,000 a year, maybe, of income, 6 to 8 thousand, something like that, from that typical retirement
Before
account.
taxes, before
Yeah, before
taxes.
taxes, exactly. Yep. And just withdrawing from that can also mean your Social Security's taxed too. That's another conversation at another time. But with these annuities, you can often turn that 4% rule, because you're building on a foundation again of protection. You can turn that into a 6, a 7, 8, sometimes even upwards of 8%, that you're able to withdraw from your account, since you're able to get more money on a sustainable and consistent basis out of that, which is going to help improve and sustain your lifestyle in and through retirement.
Now, some of the pushback I commonly hear when I talk about these products is, well, you're just pushing an annuity because you're getting a big commission. Can you speak to that point specifically? Usually you hear this from asset managers that want to maintain control over your money. A lot of people don't realize that the asset manager, the money manager, the person that's managing your account is getting 1 to 1.5% on every dollar that they manage. So they are very much incentivized to continue managing your money. If the market goes up, they make more money. If the market goes down and you lose money, they still make their 1.5%. So can you talk a little bit about and maybe give a different perspective on the claim that you're just pushing annuities to get a commission?
Yeah. Yeah, I actually really love it and get a chuckle out of that whenever somebody makes a comment like that. Because the money manager, yeah, if they're saying that, that's because they don't want you to take your money away from them, because that is supporting them. That's their lifestyle and their livelihood, right? Because they live off of your money. But the truth of the matter is, with annuities, there are commissions paid, yes. We won't deny that, and we're actually very upfront and completely clear with you on that. And most of the paperwork that you do when we do an annuity application, it lists there exactly what the commission is, and so how much we are getting paid when we do that. But it's a one-time upfront commission. It's not an ongoing commission in most cases. And the truth of the matter is, it's not coming out of your money, which is the part that I love the most about it, right? Many people think, we're using an example of $100,000, if you transfer that $100,000 over, and let's say there's a 5% annuity commission on that, right? $5,000 is paid out from that annuity commission. Well, you would think that your account would only be $95,000 at that point, right? But again, that's not the case. You transfer $100,000, you're going to have at least $100,000 still in there. The commission is paid by the insurance company that issues the annuity. They pay us out of their profits. So 100% of your money remains 100% of your money. It's just transferring from one account to another as if you transferred money from your checking account to your savings account at your bank. That's the only difference. And the other thing is that often you can even get a bonus when you're transferring money over. So you transfer over $100,000. Let's say you get a 5% bonus on your money. Well, now you've got $105,000 in your account. So not only did our commissions not come out of your money, but the insurance company actually gave you additional money that just right off the bat, just as a thank you for doing business with them, right? Something extra to boost your savings. And sometimes those bonuses can be upwards of 10, 20, I've even seen them as high as 50% in some accounts. Now there's different bonuses, and we'll be glad to discuss those particulars with you. As I said, there's over 700 different annuity products out there. So we have to make sure that there is one that's right for you, for your specific scenario and your situation. But some of those can boost up the actual premium in the account, and some of those bonuses can boost up the what we call the income bucket, which is what the lifetime income is based on in those accounts. And that can greatly increase the amount of monthly, semi-annually, quarterly, annual payout that you get from those annuities.
Fantastic. Some of my clients already have annuities. Some of them have had them for decades. Some of them have gotten into annuities just in the last few years. Can you speak a bit about why it's important to review these annuities ongoing, and if there's potential of rolling over a poorly performing annuity into a newer or different annuity for my clients that already have them in place?
Mhm. Absolutely. So yes, in the past, there have been periods of time, even if we look back over the last 5 years, right? Post 2020, post pandemic, when interest rates were exceptionally low, a lot of annuity products had very low rates in them at that time. Low rates, low caps, low participation rates, and all of that. And so some of those might be underperforming. If you got one during that time period, even if you got one, 8, 10, 15, 20 years ago, there's a possibility that there may be something out there because there's been a lot of product enhancements. There's been a lot of rate increases, all of these kind of things that could be highly beneficial to you. So it's worth it to do a review, and it's completely complimentary. We don't charge anything to do a review, but we'll take a look at it again, assess your scenario, and find out if what you have currently is serving you best. And if it's not, then we can make some recommendations about something you may want to consider that could put you in a better position. A lot of these rates have gone up, and so you might find that you can greatly increase the performance of your annuity. I've had many clients recently that I've done reviews on, and I've helped them to what I call refinance their annuities or upgrade their annuities. Even some of the ones that I did with these clients, 3, 4, 5 years ago, just because right now we're in a really good rate environment, and we're kind of in a unique scenario right now where interest rates are starting to trend down again, like the treasury rates are going down, right? And we're going to see interest rates go down, but also the annuity rates are high right now. So it's a good opportunity right now that even if you had a surrender charge or something on a prior annuity, based on exactly where we are right now, that surrender charge could be extremely minimal. Even if you looked at it 6 months ago, let's say, and it wasn't beneficial for you to move it at that point, it might be right now just because of the specific window that we're in. And I can almost guarantee you that you can be in a better position going forward.
Wonderful. Now, can you speak a little bit to speaking about interest rates and the volatility of those interest rates? Since we've had some quantitative tightening here in the last year with the Fed, interest rates have gone up. It's pretty rough for people that want to borrow money, but for interest-bearing products like annuities, it's been great. But as they're experiencing the pain, I'm assuming the money printer is going to be turning back on pretty soon and interest rates are going to come down. To my knowledge, when somebody gets into an annuity contract, that rate is locked in for the term of that annuity that you and the insurer agree to. Um, so the concern of, well, if I get in at a good rate now and rates lower in the future, what's going to happen to my annuity and its return? Can you speak a little bit to that?
Yeah, that's a very good point, Steve. And what you just mentioned echoes what I was mentioning previously, about this being a good time because of the way that interest rates are kind of fluctuating now, how they've been rising, but they're about to start dropping again. This can be a really good time to look at those past annuities. But the rising interest rate environment has presented an opportunity to get fixed rates that are very good in certain annuity products and also present with higher caps on earning potential, higher participation rates, and uncapped strategies. So there really is tremendous growth potential in many annuity products nowadays. There's a couple different types of annuities that people like to consider. One of them is called a MYGA. It's a multi-year guaranteed annuity, MYGA. And it's a great alternative to not only bonds, but really an alternative to CDs. Because a lot of CD rates are going down in banks now. A lot of high yield savings accounts are going down. And even with the CDs, you have to quote unquote lock that money up for a certain period of time, whether that's 3 months, 6 months, a year, 5 years, however long that CD is, until it matures. But again, some of those rates are in the threes or fours right now. I was just speaking with a client the other day that started out with a 5% rate in their account, and then it dropped to 4.75 and 4.5, and then 4. And now I think they're at 3.8. So while some of these MYGA products still have rates above 6% in there, and that's again, that's a multi-year guaranteed annuity. So that's a guaranteed rate that's locked in for the duration of that. So that could be 3 years. I mean, it could be as little as a year, but typically MYGAs are like 2 years, 3 years, 5 years, maybe even 7 years, and you can lock that rate in and guarantee that you're going to get that rate for that duration of that annuity product, but without regard to what happens in the market. If the market continues to go down and fluctuate, your money is guaranteed, it's protected, you're not going to lose anything. And even if the market doesn't perform over these next few years, you're guaranteed to get that rate of return. So you're guaranteed to grow your money.
In a similar scenario with the fixed indexed annuity as well, speak a little bit about that 0% floor, which is the foundation for these products, which really protects the nest egg. I know with a fixed indexed annuity, yes, it is loosely tied to the market performance, and that if the market is up, you're going to get a better return. If it's down, you may not get much of anything. But could you also speak to the contractual obligation that the annuity has in dispersing funds to you ongoing? So what are some of the protections against market volatility that a fixed indexed annuity has that differs from a MYGA?
Absolutely. A fixed indexed annuity offers the upside potential of an index such as the S&P 500. There are Barclays indexes, there are Goldman Sachs indexes. There's many different types of indices out there that you can choose from within these products. And they have different strategies. Some of them are uncapped, meaning that, there's no limit to how much earning potential there is. Some of them have even 100% participation. Some of them have maybe 50% participation. So for instance, in that case, if the S&P 500 was up 20%, you would get 10% rate of return. If there is a cap on it, maybe the cap is 10%, so you can earn up to that 10%. But
And
they
when you say participation, you mean the percentage of their money that's participating in those indices, correct?
No, the actual participation rate is the participation in that index change. So if that index changes from this level to this level, and that's a 20% change in that index, they are participating in 50% of that change like that. Now, what you were referring to with participation, there within the annuity itself, there are different allocation strategies that you can choose. So you can have a percentage of the money. Again, let's say you have $100,000, you could choose to have 20% of that, which would be $20,000 in a fixed strategy where it's guaranteed to earn a fixed rate of return, and then maybe 40% of it, so $40,000 in one index strategy, maybe with a cap, maybe the S&P 500 with the 0% floor and a 10% cap. So you can, and I'll explain more about the 0% floor in just a moment, but your money's protected and you can earn up to that 10% cap. So anything that the S&P 500 changes in that, you can earn up to that 10%. And then maybe the other 40% is into an uncapped strategy with a 50% participation rate, for instance, where that if the S&P 500 goes up to 26% or 30%, like we have seen over the past couple of years, right? Some, record returns in the market, you capture 50% of that gain. So if it's up, 20%, again, that's 10%. If it's up 26%, that's 13%. If it's up 30%, that's a 15% return. And so
Swinging
you
for
can
the
allocate
fences.
different. Exactly. And you can strategically allocate different segments of your money within that annuity to different indexing strategies. And all of it is protected by that 0% floor, which is the amazing factor of annuities. Again, building on a foundation of protection from the start. So you're not subject to market volatility. Your money is not directly in the market, but you get to participate in that index gain. That 0% floor just means that if the market goes down, like it has been these past few days, your money and all your prior gains are protected. So you are not going to experience a loss in that. You're not going to see a negative in your account. Your money is there, it's protected, it's going to stay there. And then when the market turns around and it picks back up, you get to pick back up from that same point that you were at. Versus if your money is at risk in the market and it goes down, when that drops, right? You have to start from that negative before you start building up again. So it takes a while to get back to break even. That's what we saw in the 2008 scenario, right? Most people lost 50% in their accounts. So that $100,000 account dropped to 50,000. And then 2009, 2010, 2011, 2012 were good years. But on average, it took those 4 years just to get back to break even. Those people didn't make any money during that time, but they also had to pay their management fees to their advisor who was managing their money during that time. Like you said earlier, they still get paid whether you make money or not, right? But they lost all that opportunity. Whereas if they would have stayed there, if their money would have been protected when the market dropped, you still had $100,000 there. So then 2009, 2010, 2011, 2012 were all good years. You would be that much further ahead if you built your money, your foundation on protecting the money first, right? That's why that's so important. It doesn't matter how much you make. The only thing that matters is how much you keep. And that's why we're so big on protecting money first as a foundation and then growing and building from there.
Fantastic. You're giving up the home runs to hit doubles and triples and never strike out, to use a
Exactly.
baseball analogy here. The
Yep.
team that gets up to bat and never strikes out, that's the one that's going to win the game. And so this is a long game, as I tell all of my clients, as you move in to retirement from the accumulation phase to the distribution phase. Security and protecting that nest egg must be the cornerstone of your plan going forward. We're getting a little long in the tooth here, so I don't want to lose anybody. Just in closing here, if you can talk about the nuanced differences between a properly structured annuity and long-term care and how one may be better than the other, or if there's an approach where both of these products can work symbiotically to best benefit the client. Is there any time where somebody would just go with an annuity or just go with long-term care, or is there an argument for both of these products working and creating a synergistic effect that benefits the client ultimately?
Mhm. Good question. So, in most cases, I do believe that there is a good case to be made about having both an annuity for lifetime income, but also having a long-term care plan. Now, traditional long-term care that most people think of is where you pay a premium to an insurance company every month over a period of time, right? They suggest you start in your, late 40s or early 50s, right? Because then you have a good, 15, 20, 25 years to pay into that long-term care policy. But the truth is, a lot of those long-term care companies have gone out of business and a traditional long-term care plan. If they haven't gone out of business, they have continued to raise their rates significantly, and most people can't afford them anymore.
And what happens to a traditional long-term care plan if you don't ever need long-term care?
If you don't need the long-term care, unfortunately, you lose what you paid into it. It's just like
It
your home
goes
insurance or
poof.
your car insurance. You paid into it. If you never make a claim, you've paid all that money out and you never got any of it back, right? It was good to have the insurance on yourself. So, it's not necessarily a bad thing if it gave you peace of mind, if it gave your family peace of mind and all that. But again, if you didn't use it, you lose it. And that's the issue that I find with traditional long-term care. Nowadays, with more modern long-term care options, there's asset-based long-term care, and there are ways that you can transfer a portion of your account value, your portfolio that you have now, into an asset-based long-term care plan, and you can have basically options. You have if you need the care in the future, the money is there. You can tap into it, and you can create an income stream from that to pay for the long-term care and you typically get a leveraged value on that. So whatever you put into it, you get a multiple of that back in payouts. If you don't need the care, and in the future you decide that you want to just tap into that money and take it back out, you can. You actually have the flexibility to tap back into that money. It's going to earn a rate of return too, so it's going to grow, and you'll be able to take that money back out and use it for other income or whatever you want to at that point. But then there's also a death benefit associated with that. That if you don't use the long-term care and you don't take the money out, there's a death benefit there that pays out the money that you put into it back to your family. So it's a way of ensuring your legacy and having the peace of mind that you're not going to be a burden to your family, that you'll be able to be taken care of and have the care that you desire and that you deserve later on in life, just if you need it, right? It's one of those what ifs, and I like to cover all the what ifs in life and make sure that people have a plan for all of them.
Fantastic, fantastic. Thanks so much, Leon, for your time. Really appreciate it. We will include a link in this email for you folks to schedule time with us. I'm happy to speak with you about any of these products at length. I usually will rope in Leon as he is the expert in this field. I consider myself an expert in Medicare, and I know enough about annuities and long-term care to speak from a 30,000-foot view. But when we're actually talking about case design and building these things out, I like to bring in Leon as he is the expert on these products. So. And to further note here, we can help people birth to death at the end of the day. And if you've got children that may be watching this video with you and helping you with some of these decisions, we've got a product from age 0 to about 55 that is an excellent protecting financial and income retirement vehicle that beats the pants off of your traditional retirement vehicles, IRA, 401k, 403b, etc. And that's something that would be an entirely different video that we could speak at length about. But at the end of the day, if you've have family members that fall in that age demographic 0 to 55, we can present them with some solutions with properly structured cash value life insurance that has a lot of the same attributes that an annuity has, with even greater returns. And that's simply from the perspective of the individual having a lot more time for that money and compound interest to work its magic. So we can discuss that at length with any of your family members that may apply to. So feel free to pass our contact information along to them. These are products that Leon and I both use personally as our retirement vehicles. So I would never suggest something to an individual that I don't also do myself. Annuities have their place, and typically they're for the older demographic that don't have as much time for these products to work in the way they're designed. But a properly structured cash value life insurance policy from age 0 to 55, there is no perfect solution out there. There's only trade-offs. But in my opinion, properly structured index universal life insurance policy checks the most boxes. and we'll give you
And do
a
things that there are certain things that a properly structured, properly funded, and properly utilized cash value life insurance policy can do that no other financial product can do.
Indeed, indeed. So
Absolutely.
if you've got family members that this applies to, feel free to pass the information along to them. And we're happy to show them exactly what we do for our retirement solutions going forward for us individually and our spouses and children. So yes, with that, let's go ahead and wrap this up. And please, if you want more information on any of the above, schedule some time with me. We'll probably set up a calendar that ties both Leon and I into the conversation with the click of your mouse. So follow the link that's in the email that this video was tied to. And thank you for your time and for listening in. Again, anything insurance or finance related, whether it's life, health, your Medicare insurance, of course, I'm here to help you with that at any time, but also some of these more complex income and retirement planning and estate planning strategies. If I can't help you directly, I can typically refer you to somebody who can, and that one of those individuals would be Leon here. We do have some outlets for those that want the traditional money management scenario as well, although it's not a scenario that I believe in and I don't recommend, but if you're insistent upon that, I can bring in a colleague as well that is securities licensed and does manage money as well if you want to discuss that. So anything you want to say in closing, Leon?
I think you've covered everything really well. The only thing I'll say is that when you were mentioning about that 0 to 55, just think about if you've got children that fit in that age group, if you've got grandchildren or great grandchildren, or even nieces or nephews that are important to you, that you want to help them to have the best foundation for their financial future. That's a tremendous opportunity for them because they've got time on their side, and time is the currency of compounding. So you can take a little bit of money over a long period of time and it can go a long way. And you'd be amazed at what actually happens with that. So
Indeed, indeed. I
your
say
mind.
this all the time to friends and clients that there's no bigger leg up you can give a child than one of these products because they have so much time to let compound interest work its magic. So, the contribution to these plans at a young age is very minimal. I fund both of my daughter's policies to the tune of $100 a month, and they will have a massive leg up that follows them through their life, not tied to their employer with all the strings attached and gotchas that a 401k and 403b have. My daughter's retirement plan was started 2 weeks after they were born and will follow them for the rest of their life, and something they can tap into and use as a bank, if you will, throughout their life. And it's really it it beats the pants off of any other scenario when you started early like that. So feel free to reach out for any of the above. Thank you so much for your time today, Leon. Appreciate you sharing your knowledge and expertise. And we'll talk to you soon, folks. Take care.
Pleasure. Bye bye.